This is an emergency message. I need your attention for a few minutes. Tell your dog to stop barking. Tell your boss you need a long bathroom break. And if you are watching something you should not be watching, close it now. What I am about to explain is more serious than it sounds. Today is Monday, January 26th. 2026. Silver is trading near $114. But do not focus on the price. The price does not matter anymore. The real problem is this: you cannot buy the metal. The buy button is disappearing. This is not about how much silver costs. This is about whether silver is even available. We just received confirmation that TD Precious Metals, part of TD Bank, has stopped selling physical investment silver. This is a major bank, not a small coin shop, not a website error. A top-tier bank has shut down silver sales. When customers log in, they do not see prices. They do not see an add to cart button. They see one message: temporarily unavailable. This should worry you. The media will say it is a supply delay. They will say demand is too high. They will say it is a shipping issue. That is not the real story. This is a bank run, not on cash, on real metal. The bank does not have enough silver to sell. Why did this happen? Because TD Bank made a bad bet. When silver was around $40, their traders believed the price would fall. They sold silver contracts they did not own. They bet against the market. Silver kept rising. At $50, they did not stop. At $74, they doubled down again. They believed they could push prices lower using paper contracts. They were wrong. You cannot print silver, and you cannot stop real demand. Silver kept climbing. Around $92. They were forced to quit. They had to buy back their contracts at huge losses. This cost them tens of millions of dollars. But the real damage was not the money. The real damage is this: they no longer have enough physical silver. So they shut the door. And when big banks stop selling metal, it tells you something important. The problem is not price anymore. The problem is availability. The Fed can always print more money. That is not the real disaster. The real disaster is what the bank lost by making the wrong choice. Think about this. For 6 months, instead of buying real silver, instead of filling their vaults with bars and coins, instead of preparing to sell during the biggest silver boom ever, they fought the boom. They used their money to bet against silver. They wasted everything trying to stop something they could not stop. It was like firing bullets at a tsunami. Now silver is at $114, and they are exposed. They have no metal. Their vaults are empty. They cannot buy more silver. The wholesale market is broken. They cannot call refiners and ask for delivery. Refiners are sold out until 2027. So the bank had no choice. They shut down the website. They suspended silver sales. This crisis was created by their own decisions. This is a retail collapse. This is the moment when the paper market shuts down. For years, people warned, better to be early than too late. Now it is too late. If you have cash in a TD Bank account today and you want to convert it into silver, the bank is telling you, we cannot help you. Your money is stuck in the system. You can see the dollars on your screen, but you cannot turn them into real assets. You are watching from the sidelines. The rocket has launched, your ticket has been cancelled, and TD Bank will not be the last. They are just the first domino. Every major bank with a metals desk faces the same problem. They are short. They are unprotected. They are running out of inventory. Liquidity is being removed from the retail market. The ability to buy silver is disappearing. Soon, you will not be able to buy silver from Chase. You will not be able to buy it from Wells Fargo. The only seller left will be private holders. People who bought years ago. And they are not selling at 114. They are not selling at 500. So if you are sitting on cash, waiting for a dip, waiting for cheaper prices, you are taking a dangerous risk. There is no dip coming, there is only sold out, only suspended, only silence from banks with nothing left to sell. But the retail panic is only the beginning. What is happening on Wall Street right now is much worse. Retail banks are closing doors. Investment banks are turning on each other. The first major fall has already happened. We need to talk about Goldman Sachs. The head of precious metals trading has suddenly left. You do not quit when you are winning. You leave when the damage is done. While customers demand silver from closed bank websites, something bigger is happening behind closed doors. This is no longer retail collapse. This is an institutional purge. The first leader of the paper market is gone, and the silence from Wall Street says everything. This man was running the biggest metals desk at the most powerful bank in the world. He controlled massive trade flows across the Western markets. He was the one pushing the buttons. And now, his desk is empty. His access is gone. His badge no longer works. His phone is disconnected. Goldman Sachs released a public statement. They say he left to explore new opportunities. They hint that another firm hired him. That story makes no sense. You do not quit your job in the middle of the biggest commodity boom in decades. You do not walk away from Goldman Sachs when the money is flowing like this. You only leave like that if you are forced out. Let's call it what it is. This was a blow up. This was a firing. Here is what likely happened. Traders like him are trained to believe that prices always come back down. They believe markets stretch and snap back. So when silver hit $80, he thought it was too high. He shorted it. When it hit 90, he probably shorted more. He believed retail buyers were wrong. He believed Goldman could control the market. When silver crossed $100, panic started. And when it hit 114, the market did not snap back. It snapped him. You need to understand the size of these trades. Big banks do not trade ounces. They trade millions of ounces. If you are short 10 million ounces and silver rises $30, that is a $300 million loss. That is not a mistake. That is a disaster. That is the kind of loss that ends careers immediately. This is the beginning of banker panic. He is not the only one. He is just the first. His exit tells us something important. The banks were not prepared. They were not positioned for rising prices. They were betting the wrong way. They believed inflation would fade. They believed the dollar was safe. They were wrong. Now imagine the traders still sitting at other banks, JP Morgan, Citi, others. They see what just happened. They see the boss at Goldman get fired. What do they do next? They stop shorting. They stop fighting the trend. Some of them start buying just to protect their jobs. This is how panic spreads. This is how a short squeeze becomes explosive. Fear is now driving the price higher. The people who usually hold prices down are gone. They are out of money. They are out of power. Resistance has disappeared. And while this is happening in the West, the East is doing something very different. They are not watching charts. They are checking vaults. What happened overnight in Shanghai was not normal trading. It was violent. It looked like a system error. Silver pushed toward $122, a limit up move. While Western bankers are being fired and retail buyers are locked out, the global market is entering a new phase. The real action is not happening in the West. It is happening about 7,000 miles away. We need to look at China. What happened overnight on the Shanghai Gold Exchange and the Shanghai Futures Exchange was not normal trading. This was not a rally. This was not a spike. This was a shock. Silver in Shanghai exploded. In one session, silver jumped 12.78%. It closed at $122.95 per ounce. Let that sink in. While traders in New York struggle to find metal at 114, Shanghai is trading near 123. That is a $9 gap. This is not a small market. This is the largest physical silver market in the world. A move like this breaks trading systems. It is a limit up event. The market is sending a message. Paper money is losing trust. Silver was not alone. Gold surged 3.6%. breaking above $5,100. Platinum jumped nearly 10% to over $3,300. This is not one metal. This is panic across the entire sector. This is a rush out of paper money. Chinese investors are not asking if the market is overbought. Factories are not waiting for pullbacks. Solar manufacturers are securing supply. They are buying everything they can. The price is not the real issue. The real issue is inventory. We track vault levels every day. Overnight, another 7.3 metric tons of silver left Shanghai vaults, gone. Loaded onto trucks, removed from the system. Total remaining inventory is now 18.4 million ounces. That is a tiny amount. That is less than what one major Western bank claims to hold in a single vault. That amount could supply China's solar industry for maybe 2 weeks. The market is running on fumes. When supply gets this low, price no longer moves slowly. It accelerates. It goes vertical. Because whoever holds the last bar sets the price. If you want the last bar of silver, you do not negotiate. You pay whatever it costs. That could be 150 tomorrow. The price gap between Shanghai and New York is deadly for Western banks. Why would a refiner sell silver in London for 114 when Shanghai pays 122? They would not. They will ship it east. Metal is leaving the West and it is not coming back. This is why banks are failing on their short bets. They were fighting a market being drained by unstoppable demand. They were betting against reality. They were betting against physics. And physics always wins.